Hello everyone, and welcome to the weekly Q&A for May 17th of 2023. We had a couple questions actually come in before this episode, so it's going to be awesome. We're going to kind of dig through that, and then we're going to figure out kind of what things are going on in the macroeconomics, and then we're also going to check out some options things as well, if I can get to those questions today. If not, we'll save it till next time. So the first question that got sent to us was actually about one of our services, which is the Sleep Well portfolio or the Awake. Both are just kind of a portfolio based or an ETF long only type of portfolio. We only use 6 assets, so they're all very sensitive to macroeconomic pressures. All 6 assets that we use, and basically the question revolves around why 2 of these assets are on at the same time for the time being. And the 2 assets in question are actually 2 ETFs. One of them is called UUP and one of them is called GLD. If you're not familiar with both of those, UUP follows the dollar's relative strength to other currencies, and GLD follows the strength of a precious metal, which is gold, versus the US dollar. And it's been used as a currency for a very long time, far longer than any of us were alive. So gold's been a currency for a long time, and then UUP is basically what the dollar is versus other fiat currencies. All right, so the question itself says, with the Fed signaling a pause on interest rate hikes and other countries' economies looking stronger, it's a bit surprising to see that the Sleep Well and Awake portfolios both have some allocations to UUP now. Why is that? So in order for me to better explain this, let's kind of go into, first of all, what typically drives these assets. And then second, we'll look at a little bit of history. So I'm going to show you a few assets in just a second here. Basically, one is going to be the S&P 500, one is going to be gold, and then one is going to be UUP. And we'll kind of dig into each one of these and just kind of how they flow. But these are going to be the 3 or the primary assets that we're going to look at. Okay. So looking at this here, you can see gold is in green right now. We've got UUP that's in purple, and we've got SPX that's in blue. Now, let's just go to look at a few times, right, historically, and just kind of see how these 2 play off of each other. And in general, I think the reason why this question was popping up is because in general, gold and dollar are inversely correlated, right? And what I mean by inversely correlated is that they typically one goes up while the other goes down, right? So back here you've got gold and you've got UUP, and you can see here as UUP is falling, gold was rising. As UUP was strengthening, gold was falling. And then yet again we have a strengthening of gold, and then so you can see this kind of inverse correlation. Now that's not always true, but in general that's how we kind of speak, right? Here we go, we've got gold going down, we've got UUP going up. And that's because gold really is a currency, right? But it's not always the case. And so here's just kind of a general stint right here from September as gold is rising, right? And you've got both UUP strengthening as well, right? So the dollar's actually strengthening in the background. So they're starting to correlate again. And you can even see here through this little rally right here, gold actually had a really big pop, and so did UUP. Eventually, gold comes down. And then let's kind of go through another spot here. And I'm going to kind of dig more into what happens after deflationary recessions. After deflationary recessions, typically the dollar does have a hard time. Now, why does the dollar have a hard time after deflationary recessions? And I'm also going to explain the difference between deflation and inflationary recessions, because that's going to be important today. So let me get back over here. So what happens after a deflationary recession is typically the currency is being weakened at a very aggressive pace to spur an inflation that isn't a natural inflation. So, for instance, what's happening in something like 2008 or COVID. So this is COVID, and we can go all the way back to 2008 because 2008 might just be like a cleaner example. So let me get back here. I know it's a lot of scrolling, but I'll stop, I promise. All right. So typically after a deflationary recession, we do get a weakening of the dollar back here. And you can see that back when we bottomed in 2009, you get this weakening of the dollar. And that's because the central bank has been injecting a lot of cash into the economy, right? A lot of currency into the economy, a lot of dollars. They've been trying to instigate more lending to expand the money supply, because that's how you can fix deflation through the monetary system, right? Because it's not natural inflation that's happening. What would normally cause a natural inflation would be the economy stabilizes, austerity kind of kicked in, right? And then now everyone's kind of feeling better. The economy's starting to build up again, and then now a rise in income and general buying pressure, and everything starts to build businesses again and everything, and it starts to create that inflation run. That is not what's happening, right? What's happening in something when a central bank gets involved is there's actually kind of like fake inflation, right? What happens is they inject a bunch of money into the system, right? They print money into the system by either dropping interest rates, that's one form of printing, or buying assets, that's another form of printing, or of course then you've got also the government sending out checks. That's a really bad way of printing, but sometimes is needed. Okay, so that's ways to instigate inflation, but that's fake inflation, right? Because we're just printing dollars. And this is all very important to understand why UUP is in the portfolio right now. So it's a little complicated, so hold with me for just a little bit. Now, what happens here is that as that inflation is still being pushed into the system, you're flooding dollars into the system typically at a faster rate than that of other countries, and that's because the US is a reserve currency. So typically the reserve currency gets pushed first or acts first, and then everything else kind of has to react to it to kind of reacclimate, right? So kind of imagine it as like the dog and the tail of the dog, right? The reserve currency is the dog, and the tail is actually the kind of the rest of the currencies worldwide. And so when you get these large macro shifts, right, these larger cycles within these little ebbs and flows, these larger cycles, the dollar normally reacts first. So with that in mind, because that inflation's finally kicking in the reserve currency and the reserve currency's economy, boom, inevitably what happens is that inflation kicks in, and the other countries around the world, other currencies around the world will stall out, right? And then eventually they will start to drop back down, and then that re-strengthens the dollar for a little while. And then the central bank can do one of two things: allow it to re-strengthen, or weaken it further and create another, spur into the economy. And sometimes that's needed, but that's what happens, right? So you can see that's what happened in 2010. Here's that re-strengthening of the dollar, right? And then the US government decided that it needed to re-weaken it. So it spurred it again back in 2010. And then eventually we make it all the way to the debt crisis, right? That was when the dollar was getting re-strengthened in 2011, or at least it stabilized. That was when a lot of people thought the dollar was going to go into destruction mode. But yet again, like I said, dog and tail, right? What ends up happening is that this is near time for the strengthening cycle to start kicking in. So it re-strengthens, right? And then we go all the way until we get to mid 2012 or so, and then we start to kind of inject. We start to do like Operation Twist and some other things, and then 2013 was quantitative easing again, so that weakened the dollar again. So, anyways, like I said, this is a whole long spiel, but eventually we stopped weakening the dollar. Sometimes in 2014 was when quantitative easing stopped, and then eventually we were getting ready for raising interest rates. We were one of the first economies around the world, and yet again, strengthening of the dollar. So there you go. So that's your kind of the wave, right? If I could say anything or at least allude to how something reacts as far as like a wave, and I can kind of draw this out because this will happen. This will kind of help. So imagine that the dollar, or the reserve currency, I should say, kind of moves on this wave, right? And so that's our blue line right here. And then let's just imagine what happens to everyone else, right? Or I should say just non-reserve currencies, is that they're just like a little delayed, right? And we'll just make this a different color here. We'll make this red. And so because they're delayed, now imagine that the gap between the two, so this gap between here and here, is what creates the strengthening and weakening of the currency. So imagine here, if that gap gets wider, right, that currency gets weaker. If that gap gets tighter, or it starts to drop faster than other currencies, right? So if the gap gets wider, but the reserve currency is on the bottom side, that strengthens the currency. And so that's basically what happens, is you get this strengthening of the currency that starts right here. Boom, strengthen. And then once you get down to about here, right, now the other currencies are starting to catch up, and the gap starts to close, right? And that's what creates that cycle. And then eventually you'll see that it kind of flows into the other direction, right? And if I turn this to here, I'll just draw this first, but it'll start to kind of go like that, and I'll turn this back into blue. And so it kind of works like this, right? You reclose and then you flow. So just imagine that it's kind of like a derivative of the reserve currency. Okay, so that's why the dollar is in play, is because of that relationship right there. Now, as far as the dollar is concerned, let me get out of this. I think if I just right click. So as far as gold is concerned, what happens in an inflationary recession, right, is that there was too much inflation, and the strengthening or the tightening of the monetary policy actually happens in the beginning of the recession, right? So unlike 2008, where we're easing financial conditions and weakening the dollar as the crash is happening, the opposite is actually what's happening, right? So here's the original weakening of the dollar as the market is kind of coming down, right? And then here's a flight to safety, by the way. But if we go to, and I'm just going to zoom out because it's going to be a lot faster. If we go to the inflationary recession that we've had right now, right? Through this inflationary recession, there's no weakening of the dollar. There's a strengthening of the dollar because of the tightening monetary conditions faster than other currencies. And so that's destroying dollars in circulation faster than the pace at which other countries are, or at least our trading partners. And so what happens is the dollar becomes stronger, right? And then eventually the rest of the world kind of reacts, and then comes around, and then you get the weakening of the dollar. Then what inevitably happens after an inflationary recession is, once everything starts to settle in, right? Once that weakening starts to settle in as the bottom of the recession kind of starts to form, right? And this is an asset recession, right? Then what ends up happening is you get a little bit of a re-strengthening of the dollar, right? And then the inflation will really start to kind of cool off, right? And that will normally push inflation back down to its normal levels or so. And then the central bank will decide if they're going to ease more rapidly, right? Or if they're going to stall or re-strengthen. Right now, it's more about a rate of change that's going on, more so than necessarily are they easing or are they tightening. It's, are they tightening less, and that's what's actually that's what created the weakness in the dollar in the first place. Is the U.S. central bank was one of the first to start, easing. Now China's on a totally different cycle, so keep that in mind. But as far as the dollar strength, the euro is the next top currency, so it has a lot of impact with the dollar. And then when that easing condition starts to show up, so does gold. So right now we've got this cycle that's going to start to happen where we're still going to have above normal inflation, and we're going to have dropping of interest rates, right? Real interest rates, which will be helpful for gold, right? Because gold is a hard asset, not a fiat currency. But at the same time, it's also in time for the cycle for the dollar to start to re-strengthen as other currencies catch up to that waveform that we were talking about earlier. So it just so happens to be that both are kind of linking up at the same time. And this is only something that happens in inflationary recessions and not in deflationary recessions. So that's why it's so important to have a macroeconomic portfolio like the Sleep Well or Awake, so that you're not dependent on old relationships in the last recession that aren't going to happen in this recession, because this recession is driven by a totally different animal than the deflationary recession of 2008 or .com or the 90s, right? Early 90s. Now it's going to be more so of like what happened in the 70s. And a lot of us know exactly what happened to gold in the early 70s, right? Or in the 70s in general, when we first became a fiat currency. All right. So the next question we're going to tackle, and hopefully that kind of clears that up. By the way, if it doesn't, go ahead and throw something in the comments and I'll make sure I loop back through it, okay? All right, as far as the next question that we got sent to us. So you've mentioned before that the bond market pulls the Fed rate and not the other way around. So in this part of the cycle, the lower yields on the 1 and 2 year treasuries will eventually force the Fed to lower their rate. Can you step through the mechanics of why that is? Yes. All right. So in order to accomplish this, we have to look at the yield curve. And we're just going to grab a yield curve from a website here, so that way you can look at it anytime you want. And we will go from there. Let me get to, yes. All right. And you know what? We'll actually go to I want to say, one second here, and let me pull up something that's a little bit better than that, actually. There we go. All right. We're going to share this tab instead. Okie doke, guys. So here we go. We're going to, this is like a dynamic yield curve chart. These things are actually really awesome. So shout out to stockcharts.com for creating this. There's a couple others out there, but anyways, this is just the one that I'm going to grab really quick. So what we can do here is we can actually click on different time periods and look at these dynamic to see what the yield curve is. And as this person had stated, that I always have phrased it in the fact that the rest of the yield curve kind of pulls the Fed around and not the other way around. And that's very true. So let's kind of walk through how this kind of happens and why this is. So in general, you can see here that, by the way, the Fed, besides some extraordinary measures, the Fed controls the risk-free rate, which is the front end of the yield curve. So just imagine in our mind up here that on the very left side of this graph is the very front end of the yield curve. For those of you guys that don't know what the yield curve is, basically if you were to purchase a bond at the current risk-free rate, saying that it's right here, and let's say the risk-free rate, the overnight window is, in this case, it's probably, maybe 1% at this point. That's what you'd get. You just get 1% yield, basically 1% annualized yield. And then if you get out to 20 years, right, you'll get a rate of, let's call it 5%, right? So in general, you want to be further out on the yield curve if you're going to hold to maturity. And then closer in, you're not going to get as much yield closer in, right? And this is a lot of the reasons how, anyways, I'm not going to talk about that. I was going to go into banks, but we're just going to go away. Anyway, so as we start moving, you can see here just how steep this is. So that's called a steep yield curve, is when this thing looks like it's climbing a mountain, right? When it's very low over here and just steep, right? As the economy starts to continue to flourish, right, and you're going through a bull market, this is the .com, or this is the '08 bubble that eventually, will pop here, but that is a growth. It might have been through monetary policy, so it was a little fake there, but it's okay. So you get this growth, right? And what eventually happens is the bond market stabilizes here, and as the Fed stays and puts pressure artificially below where the mean yield needs to be. And just a way to kind of imagine what the typical yield curve looks like is you can kind of flow somewhat kind of like the square root of time, but it's not quite, but basically like almost a straight line through the yield curve with probably just like a slight bend. Like just kind of imagine that in your mind. I won't go through the equation right now, but anyways, that would be kind of like the natural yield curve. So if you ever see this front end depressed kind of below all of the general yield curves, like as far as its slope going into time, it means that the Fed is keeping it down, right? And what that does is, in order for them to keep it down, they end up having to purchase an in excess amount of treasuries, right? And they roll these over, or they purchase more, or whatever. They're expanding their balance sheet. Anyways, what this does is it puts new money into the system, right? It creates new money. It also makes it to where banks can lend at a lower rate. And so it spurs them to actually have profits from lending at one place in the yield curve, like say farther out, and then loaning it at a less rate. And so they end up making money off of the central bank, and that puts new money in the system as well. Anyways, so basically when they're below, keep in mind that they are creating inflation, right? So let's just kind of keep that. Well, then inevitably they don't need to create inflation, and the bond yield curve will actually start to lift up because inflation expectations start to rise. And as inflation expectations begin to rise, it forces the Fed to react to that, because if the Fed keeps it down low, they're actually exacerbating the problem by creating more money as the yield curve kind of runs away from them. And they don't always want that. So what they'll do is they'll start catching up to it, right? And so that way it kind of keeps the amount of new money that they're creating at like a status quo. Then whenever they get to say something like a more neutral rate, so you can see this is the yield curve, the belly of the yield curve pulling up, right? And it's going to eventually pull the Fed up. The Fed's going to react to it eventually. See, here they are. They're starting to lift the front end of the yield curve. Now they're starting to get to a more neutral rate. They're still a little bit lower, right? But they're basically at a little more neutral rate. So they're not stimulating as much anymore. Then as they continue to raise, right, all the yield curve expectations, they're right there, right? This is still relatively neutral rate. They're kind of low. You can see that they're just depressing the front end of the yield curve just a little bit here by maybe 0.25%, maybe half 50 basis points or so. And then eventually we get a flat yield curve or so, which is kind of an anomaly. You shouldn't have a flat yield curve. But basically what happens here is that, or an inverted yield curve, it happens is the longer term inflation expectations are lower than what the shorter term inflation expectations are. And this normally happens when the Fed has stayed down for too long and has basically been a little bit too easy on their monetary policy and created a little bit too hot of an inflation. And just so their short-term inflation expectations are a little high. Inevitably, what ends up happening is to react to that, the central bank will eventually raise their interest rates and invert the yield curve as it kind of pulls them up, right? And so they invert the yield curve to try to stop that inflation. But that's a pretty dramatic move, right? Because once you invert the yield curve, that can really have a big tightening effect. and especially if the inflation isn't very high, right? And then eventually that creates a deflationary spiral because you get the contraction in monetary policy ends up blowing up like really risky assets and things like that. So like Bitcoin, things like that. So that's how the yield curve kind of moves around, right? So at the very bottom, and so here let's kind of move to today, right? So you can see here through this inflationary recession, right? So we were talking that the Fed was basically way too low for dealing with the inflation spike that we were having. We talked about that in late 2021 right here, that they were staying too low for too long. And it not necessarily just because not just because of the inflation or the interest rate, but it's because of the amount of quantitative easing they were doing. They were really printing a lot of money in 2021, and they needed to stop. Otherwise, they were going to create an inflation spiral. And that's what happened. We got an inflation spiral. So anyways, you can see here the first reaction, right? You can see the belly will start to lift. Boom. We get a lift in the belly. Okay. Now the Fed is going to have to react. Otherwise, they're printing way too much. And also, this is late 2021. They're printing when we have like 8% inflation. It's just stupid. Anyway, so here we go. Bond yield curve starts to spike really aggressively. Nope, this inflation's way too high. The Fed is way behind the curve. Yet again, way behind, pulling the Fed up. Now the belly of the curve started to pull back just a little bit, right? So now that the belly of the curve, and you'll see the belly of the curve will start to drop, even though inflation is still going high. Boom, you can see the belly of the curve is starting to pull down, and the front end of the yield curve is starting to spike. So now the next step is an overall reduction in interest rates, typically as this disinflation kicks in and we get back to relatively more normal, and this will uninvert, right? This will kind of pull back. Inevitably, what that'll create is it'll create another inflationary spiral, and then the Fed will have to do the same thing again, and we'll go through another inflationary recession. Typically, the second one is worse than the first. So we're pretty much done with the first one. Our second one probably shouldn't show up until early next year, probably. We'll have some corrections and stuff like that, normal stock market garbage, but typically the next recession is a little bit further out. So yeah, that's how that cycle works. Let me make sure nothing came through as far as questions about that. Okay, next we are going to, oh, by the way, these are always recorded on YouTube, so you can always go back to our live broadcast. So if you go to our channel and then you scroll over to our live tab, you can see all of these, and we can post them. And then I'm going to start cutting up like certain sections of these and posting them as regular videos because we've got some requests about that. All right, so this last question is a little bit of a doozy, and it will finish us off, so I'm not going to get to the options questions today. All right. How would I play a 10% correction for the summer / early fall? Suppose that I were to think that the market will top out around 42.50 in the next month or so. And at that point, you enter a trade looking for the market to drop 37.50-ish or so. You're more confident in the price target than the timing. The target may be reached anywhere from between July to September. You'll exit for a loss if the market goes up to 43.50. All right, so this is a really complex question. And the way that I typically play things is I play things through options, which... we can probably pull that up here. Let me kind of make this. So as you guys, probably most of you guys know that I have an Adapt Advanced service that goes through custom building structures designed for the current options market and the current options environment, along with macro environment and all sorts of different things. So I'm going to kind of, maybe allude to that a little bit, but I can only design a structure for what's going on kind of right now. And there's a few things that can change in between now and then that would make me design a structure differently. So we'll just kind of deal with kind of how the market moves and kind of how I would play things, right? Depending on what DTE I'd be in, I would do this with options, but Currently speaking, since we're kind of talking about a longer term flow in the market, I'll talk about just in general if I were to be out at like, let's say 50 DTE or something like that. So I might not need to pull up the options side of things. Let me just go back to the S&P itself, and we will hide everything else. Okay, so here we go. We've got the S&P 500 here, and let's get down. So this is a daily, and let's turn this back into candles because that probably makes more sense for most people. By the way, my candles are all black and gray, so that way it doesn't instigate, oh my God, it's red. They're all opportunities. All right, so here we go. So we got a little spike right here. Even my metric is actually showing just a little bit of bullishness right now. We actually just recently flipped. I think today, like early this morning, I think the metric actually flipped to more pressure, more energy to the upside. So that's exciting news because that should flow through with the rest of our stuff that's kind of agreeing with that. So in general, let's kind of let's map out what this person is kind of saying for what the market is going to do. We're going to turn this back into currency. So basically, this person is saying 42.50 is probably when it's going to top out, and somewhere between July and June. So let's just say like that's kind of the general topping out. So that's probably not very far off. My targets for probably the next month or so are somewhere around like 4,300. So pretty close, right? So in general, this person is saying that we're going to get a flow up from here. Let's call it somewhere around here. And then eventually we're going to have a 10% correction in late summer, early fall, something like that. And then, who knows from here? This is all just who knows, right? But basically that's the move that we're kind of playing. In general, are we going to play it? Well, confidence is a big deal. So let's kind of start to draw in different ways that it can do it, right? We can rally straight up, and then we can chop around, right? And chop and chop and chop some more, and then we can just crack, and then, figure out from there, right? So that's one way that we could play, or one way that the market could play it out. We could also chop a little bit more and then get a spike later, and then hang out up here, and then just slowly fizzle out, right? Does that kind of make sense with the waveform in the market? Not so much, but who knows? We'll see. So let's kind of make some of these different colors, and we will grab, let's say this one, and we'll turn this one like orange. So here we've got a couple lines and a couple different ways that this can kind of play out. So the challenge that I have with this question in general is that you're playing a two-move market, and a two-move market, which is basically, hey, I'm thinking we're going to rally, and then we're going to correct. I typically like to just play the first move, wait for the environment to flip, and then see how I'm going to play the second move, right? Because that's a little bit easier than to try to plan both moves first. So the initial move is the rally. So I would make a plan for that first. So in general, right now, I would plan for a structure that's going to really enjoy this rally, right? And then just make sure I mitigate my risk to the downside depending on how confident I am. And in general, right now, as you guys know in the Adapt Advanced metric, that flat butterflies to the upside are at a significant advantage right now. That would probably be one of the primary structures. I would definitely stay away from put credit spreads. Those are garbage right now. And maybe some call debit spreads if I'm really aggressive on it happening really quickly, right? That would be your determine. So if a slow rise is going to be your thing, I would go with a butterfly or theta-based structure to the upside on the call side. If it's going to be a quick move, then go for some debit spreads or even some ATM calls. Let's see. That would probably work pretty well. Even ITM calls are rather cheap right now. So one of those two things. OTM calls are inexpensive right now. The only issue with OTM calls right now is that the Vega drop right now is probably going to be rather excessive until we get down to until we get the rally, and then it would be probably safer to grab those. So anyways, I'd probably stay away from those in general. I'd probably just do a butterfly with some positive delta. Now, once that has kind of transpired, or at least I got close to my targets, of course, hopefully I have some other metrics that I would kind of neutralize that, right? As you guys know in Adapt Advanced, there'd definitely be some neutralization going on. We'd start to see that energy and the stretch structure would change on our metric, right? So then what would happen from there is how to play the downside, right? Now, I would probably switch into a totally different structure. Once I got into from my bullish structure, I'd switch into more of a neutral structure, right? So depending on your confidence, of course, that's the thing, right? We have all different types of risk metrics. So as far as my confidence goes on this down move, say an aggressive 10% correction, I'm not necessarily confident in that, but the market conditions could change enough to where I could be confident in that. So if it's going to be a quick drop, that would be not what the market is kind of preparing for right now, as far as my metric is concerned. But let's just say that we're going to get a drop similar to how we have back here, which I don't believe is going to be the case, but that's okay. Let's kind of walk through this, right? That's a relatively aggressive drop, and let's just kind of grab that and throw it on over here. So we've got, roughly speaking, let's call it a month of pullback, right? A month of pullback from there. So what's the best trade to deal with a month pullback that's kind of choppy in play? Well, if we've got structures in play that are beneficial to the downside, that we could maybe load up on a time structure to the downside, whatever's in play. Maybe a calendar's in play, maybe a butterfly's in play. I don't know in that situation, but I'd probably put some sort of structure. And since it's about a month away, I'd probably play it at about 20 days out, depending on kind of what's going on. If the volatility is pretty low, I'd probably play it a little bit closer. And then if the volatility is high, I'd probably try to play it out a little bit further in time. So it just kind of depends on what the market conditions are right there. And then from there, I'd start to say, okay, if we've got some opportunities for some structures like out of the money puts or something like that, I could load up on some of those and then wait for some of these really big flash drops, right? And on a couple hard flash drop days, I would just sell off my puts and then just leave that time structure there and basically decrease my delta down, and then just kind of see if we get a couple rallies or see when that happens, and then probably load up on some more puts again. So I'd kind of play it with a time structure and then a put structure, and then just kind of play it back and forth if I'm pretty aggressive on the direction. Now, both situations that I just talked about are very directional aggressive, and that's because the question was very directional aggressive. Typically what I do is I do a little bit more of an environmental approach that's a lot more neutralized. And then sometimes if I've got ways to be directional, I will be. It also depends on what time frame I'm trading at, and I change that depending on my metrics. So that's the best way I can kind of describe how I would play that out. But like I said, a 2-move system, don't try to take the whole thing at once. Break it into each move on its own. And in fact, I'd probably break this into 3 moves: the rally, the neutralized, and then the drop, right? And then I'd have some sort of plan to say, okay, the rally's over, or this is my target. And then, okay, this is my more neutralized stance. Let's let the market figure out when it wants to drop. And then that's when I'd be a little bit more on a neutral structure or something like that. And then once it starts to crack, or even before it cracks, if you're pretty confident in your call, you might even be able to like put on some negative delta on a big rally at the end of the cycle or something like that. All right, guys, I've been crushing through those. Those are the 3 basic questions that we had, and that ran us up on time today. So I'm going to call it done right now, and I will talk to you guys next week, unless someone grabs me right before the end with the question, and it doesn't look like I'm going to. All right, guys, I'll see you guys next week. I look forward to it, and I'll take more of your guys' questions. See ya.